All right, guys and girls, we're looking at doing a little class here. It's November 24th, 2015, and I thought to do maybe a basic class, just a basic class using trend lines, support and resistance, and it's so easy to get away from the basics. It really is. It's so easy to get away from the basics of trading and get fancy with fancy schmancy with everything else. And if we go just get it back down to grassroots, we want to look at swing highs, swing lows. Nothing so spectacular. I got nothing on my charts right now, so um, I want to fix my screen a little bit better. Okay, I'll tell you what, I want to fix it a little bit better. I know it sounds like a typewriter to you guys. All right, and I just want to get everything a little bit better than it was. Okay. Where you just have to focus on the charts and my tools. And I take this, I put it here, give us a little bit more room to work with. All right. And we can go through the different pairs. We're going to go through the different US pairs. But when you're looking at charts, all right, I like to look at where's the recent swing highs, where's the recent swing lows, where's the long term swing highs and lows. What should I be looking at? And I always do that. So let's take the markets. You always want to look from the highest time frame back. You always want to look at the highest time frame back, okay? Look at the highest time frame and see what has happened in the past. I like to, and we take ourselves back to here, I like to look at all this data from the past. From here, all this data in the past. And the markets can tell us a lot, all right? So I'm not one of those Facebook magicians or people write books and they show you stuff from the past, but you really have to look at the past to learn. And I like looking at these examples. Now, right here, okay, I want you guys to make a note. Let me see if I can draw this out. Let's do this, and we'll just keep another color, okay, and we'll put it like a little bit thickness. So that way when we do something. So I want you to look here in the past, all right? And let's start from here. What we notice right here is this box, okay? This box. And we'll start our journey from back here. What is one of the first things we actually see back here? All right? I wrote down shapes, arrow, arrow down. So we look right here was a swing high, right? That was a swing high. And the markets love swing highs and swing lows. They love, alrighty, they love swing highs and swing lows. They just do. So if we look here in the past, the market had put this high in, and this test up here was basically what they call a retest of this high. So right here you have what's called a retest. Once this market has failed, this is considered a double top. So this bar moved away from this, and this is a weekly chart. The market bar moved away from that, and a lot of times you're going to see market highs and lows come off of these tests, these double tops, double bottoms, or what they call a failed test. So down here, you can see market put a low, and then you had that higher low. That was a failed test, or a higher low. Here, considered a full failed test or a double top. Now, in technical analysis, you need 2 data points to be a legitimate swing high or swing low. All right, swing high or swing low, or what we call resistance or support. So 2 data points in technical analysis is basically valid support or resistance. I know a lot of times we see 1 point and people think that's it, that's support, that's resistance. It is to an extent, but the valid support or resistance typically comes from 2 data points, okay, not 1. Now, market broke to the downside. We see this, and also uptrending market, right? So pullbacks are typically support. Here, market found support or stopped going down, tested up, and then tested again and made that little test, that double test. So if you just look right in this box right here, just alone looking at the technical aspect, the market has defined itself as a support here and a resistance here. It's basically created that box, so to say, where the market's been chopping around. Once it's failed going out of the box to the upside, all right, you get that double top, and now it has failed to the downside. A lot of times you get it at turning points. When you get these turning points, that leads to extended moves also. Lots of turning points come from double tops, double bottoms, higher lows, failed tests. All right, you get that. Let's continue down. Now, I want to look at where support or resistance can come in. So the market, basically, if we were to look at the past, we can take the past. All right, take the past. I like drawing trend lines. All right, I love drawing trend lines. I love drawing horizontal lines at swing highs and swing lows. All right, here's one right here. Oops, I'm sorry. There's one right here. The market failed to even acknowledge it on the way down, and that's fine. Let me just fix all this properly here. However, if we look at the past, all right, we look at the past. Let me just make sure it's not going to bounce back on me again. Okay. We look at the past. We look at all the data. We have this little value area here. You have swing high here, swing low, little swing high. You have, what else do we have in here? Nothing else. So I look at this and I say to myself, okay, let me just get rid of this. This is in the middle of nowhere. That's in the middle of nowhere. And I start defining from the past. I start projecting forward, looking at zones. And in this case, I take the past and I shoot it forward right here, right there. I take the past and I extend it forward, and I look at where the markets should stop going up or down. I look at prior data in the markets. I take my horizontal lines and I plot them. I look at little swing highs and swing lows. Then I look at the ones that are bunched up together and I eliminate the rest. All right. Can you guys hear me good enough? We're doing a live class here for those of you that are hearing the recording. Can you guys hear me clearly? right, so let's just take this off. All right, let's just take a journey through the market here. So always start with the highest time frames. Then, and the reason I drew all this up here is we want to establish something else. That market had left this range low. This right here, just like this, okay, just like this, is considered a pocket. All right, it's considered a pocket. So if we look at this like that, that's considered a pocket. All right, just like you would have a pocket, right, in your pants. Your pocket starts at that horizontal line into as deep as the section goes. I know you don't really see this being taught out there at all. And this was taught to me by a good friend of mine. His name is Damon Pavlados. And he was my former business partner's husband. And we used to call him Pocket Man. He came up with this and he discovered it. So what I like to look at is little pockets like that. When the markets, a lot of times they'll go and they'll test back into it like this. All right. Prior to that, okay, so I'm showing you what that is. But prior to that, all this data here, okay, if you were to look in the past, you're just dropping swing highs, swing lows, and middle, okay? When you start to lay this in, all this right here, it starts to make sense, right? Going forward, all this data here. This is why a lot of times we look at zones and I look at prior data. All this right here is considered value, a value area. This is value area. This is value area. This is where prices have come to a conclusion and eventually break out. They basically come, they rest, they make a decision, they go the other way. Well, all this data here, this leaves clues. It leaves information for us to use in the future. So you can see here now the market jumped back up. I'm not using any Fibonacci or anything. I'm just looking at what happened in the past. So taking you through this journey, you can see how swing highs, swing lows really play an important part of the markets. Look, back before anybody did any kind of Fibonacci or retracements, that's all they had was their swing highs and swing lows. I could draw this back to even up in this area if we take a look. I'm drawing this stuff out so you can do it on your own. Look right here. All that data right there. All that data is important. All right. You also have your little pocket. All right. You can draw your pocket like that. It's really like this. All right. It's really like that. Okay. That's your pocket if you think about it. So when this market was coming up, you could best believe all the major traders, technicians, they weren't plotting the Fibonacci. They weren't plotting they were looking at all this prior data. All the computers were looking at all this prior data, basically saying, well, we could short it here and we could put risk up here. Okay, no matter how wide it is, it's all self percentage adjusted. They look at this, all this here. This is more important than a Fibonacci level. This is more important than some kind of an indicator. You know, swing highs and swing lows are the most important thing you can look at in technical analysis. All right, there is nothing better than swing highs and swing lows, data points, market consolidation points. All right, so let's continue forward. In just the recent experience, let's take this. Let's take this. All right. Okay, you can see back here, if we look in the back, we got this. Okay, and those of you guys that have been with me know that if we look in the past and we draw those lines out, look what we have. The market had recently tested this area again, right? It wasn't too long ago, a couple of months ago, where the market tested up here, and everybody's wondering, well, why did the market fail? Well, if you tighten up your charts a little bit, you can look here and clearly see what the story was. You can clearly see data point, data point, data point created this little zone, and when the market retraced, it wasn't retracing at a Fibonacci level. It was retracing to a zone where the market has been before. It's left these data points, and all you're doing is drawing horizontal lines and just identifying them. All right. All right. So let's go back and bring this down to a daily chart. And let's bring it back down to the recent past. Okay, so let's bring it back to the recent past of what we've had in the past 6 months, 7 months. Hold on one second and get a little bit of water here. Okay. So if we look at the past, the recent past, let's draw a swing high, little range, right, of the zone. Swing high, right? And you can see just to start, price left a data point. Let's draw another one. I left you a data point. Then it went up again, found resistance again right there. Let's draw it again, another one. So if we just look at this past going from March to May, this retracement up in a downtrend and this lower high in a downtrend, these little retracements up became important data points, right? You can just see right here. So the market did its correction up and it formed that, looks like, try to form its little pattern here, right? You know, and everybody in the world is drawing their harmonics. You know, everybody's a harmonic trader now. Okay, and everybody thinks, okay, that's the point. But the reality is, when we're looking at harmonics, when you're looking at trading, you're also looking at the past data. So just let me hold on a second. Let me just check our trade here, guys. Guys, you want to keep your stops at break even on the balance. All right, keep your stops at break even, 91.75. And stay long the balance. You exited half of it up here, half of your trade. If you had a one lot, you exited half. All right, let's get back to our regularly scheduled program. So you can do all the Fibonacci's you want, all the harmonics you want, but the bottom line is prior swing highs, prior swing lows. We go through here, all right, and we see down here, all right, we see all this. See this right here? It's a failed test of the lows. All right, market stopped going down. Important points, guys. Market highs, market lows. Here's a market low. It's testing. Comes all the way back up to these market highs. Fails. Comes back up again. Fails. All right, you guys following me? Comes back up again. Yes, it broke through. Gee, let's take a look. Market swing high. See? I know it's easy to see after the fact, but if you place your trend lines and everything prior to the fact, it all makes sense. And those of you guys that have been in my live trading room for a while or on our night owls, we do this live. We look at this live all the time. So the market up here failed, and when that failed and we came back here, guys that have been in my room for some time know that we've looked at that as a short. We've looked at that as a short. Okay? We've looked at these data points as shorts. We actually even was screaming one night on a night owl that right there is your short because the market, see this swing right here? If I was just to duplicate this and bring this here, it's exactly the same length. You see that? So once that failed to go up and the market stopped going, we had a bounce. We look at the short side and we were projecting a much larger move to the downside. All right, this is one of the things that we had been looking at for quite some time. And when you look on our night owls, the larger time frames, this was one big giant corrective wave down. You may not be able to see it, but if we were to take this move down, this move up, right? This move down, and this move up, this is what's called an ABC corrective wave in technical analysis. But let's just stick with the basics. So we see that the market's in an overall downtrend and it's failing every single time it comes up to these prior swing highs, and it leaves clues, just like success leaves clues of where data points are. So if we were just to draw this again, another data point in here, and just keep adding to it, you see how we keep making this area thicker. All right? The more you add. So now when the market got here, tried to go above and failed, that was it. All right? That's telling you it's not going up any further. So swing highs, swing lows. I know everybody wants to use the Fibonacci. Everybody wants to use the harmonics. Everybody wants to use indicators or the special market maker tool or whatever, which I think is bogus. Quite honestly, I think it's completely bogus. So now, right down here, you have support. I wouldn't touch anything on the buy side really unless you were to get down here. There's no reason. Look in here, okay? Look in here. If we were to look here and here, right? And here, right? If we were just to take this data and stretch it across, you can see that on the way back up, it became important resistance again. All right, became a resistance again. So swing highs and swing lows become really, really, really important when you're trading. Okay. Also, we have these data points. You have these consolidation phases, right? These consolidation phases. You have a low of it, you have a high of it. So let me show you. You have the high, you have the range low, and you have the mid-range, right? So if we consider that market broke to the downside and on the way back up goes right into this range, can't expect it to go too far, right? Because of all this prior data. This is what I look at. I look at this all the time. When we're trading, I'm always looking at prior swing highs, prior swing lows. All right, so let's bring us to where we are now. Ay, 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 ay. There we go. So if we were to take the middle of this particular range right here, you can see the middle of this range. This is where all the data, okay, if we took a halfway point, all the data, okay, is bunched up right in here. Okay, so if you were to take this big line and draw a big black line right through it, it's pretty evident this is where all the data is. I like to take horizontal lines through batches of data like this and just draw it across. And you can see where the market has found support and resistance in the past, but right in the middle, now when the market comes back up, it has to respect this zone. It has to, all right? You have to look in the past at what the market has done and respect it. Right here, there is nothing happening. All this is doing right now is the market is gone down. It's created that little ABC wave up, A, okay, B, C, up. But where's important data going to be now? Where's all the important data? Right here. Okay. So right now, I don't really see this market doing much. You're in the middle of a range. The euro is basically going to sit sideways. All right. There's no news. And it's attracting. It always attracts back to the middle. It always does. All right. People look at this and they can call it a Gartley, call it whatever you want, or a shark, or whatever you want to call it. The bottom line is take away all the fancy smanchy stuff. Always looking at the past. Always looking at what has happened in the past. All right. Let's take okay. Take any chart. You can just see the past. Okay. Let's take a look at the past here. So you see how all this data, all these swing highs, market's struggling up here, struggling up here. All right. Down here. Just recently. See it down here? Just recently. And this is giving us a trade pattern, right? I believe here, 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 here. All right, it's giving us a pattern down there to work with. It's also giving us a larger pattern. You can see this here. All right, but all this data down here, it's important, right? Important to watch. This market should be able to hold steady Freddy here. If it starts to hold, we can have a whole nother drive up. So if we're looking now, look at where the data is, all these little data points. You see? Market's respecting the prior data. Okay? So the market is now respecting little prior swing highs in here. Okay? It's respecting it. You see it. You see it happening live. All right? So the class today is basically understanding what has happened in the past and to use that for the future. Drawing your lines, drawing your horizontal, drawing your levels. where you see things bunched up. That's what I do. You guys see me do this live all the time. Sometimes I really don't get so deep into it, but I draw all the time. Okay? So we're going to end the class. Just wanted to get you guys highlighted so you can sit and do this yourself. Tomorrow, what we're going to do is we're going to get into some Fibonacci. And I'm going to show you some really cool tricks with Fibonacci. Stuff you don't learn pretty much out there anywhere, right? I'm going to bring you into the world of Fibonacci and talk to you a little bit deeper. You know, that's interesting you said that. Watch this right here. Actually, tomorrow I'll teach you Fibonacci, and then I'm going to teach you Gann balancing points. In terms of Gann lines, all this stuff, I don't know. Gann went a little bit nuts at some point. So there's a couple of things I like to look at is time. I like to look at time, and I like to look at price. I like to look at time. I like to look at price. I like to look at sectors of time, sectors of price. Yeah, tomorrow's going to be recorded. So I'm just going to stop the video.